Think beyond traditional business banking. Think a partner that gives you in-depth financial insights.
While inflation in most developed markets has peaked and has shown continued signs of easing, pricing pressures in some African countries are still on the rise. Think about inflation in Egypt, Ghana, Nigeria, Zimbabwe and Angola right now, ranking amongst the highest on the continent. But the question we're asking is, will easing inflation in the US, in the UK and even in Europe that could possibly be accompanied by fewer interest rates from those economies support declining price pressures in Africa? Or will deeper structural changes on the continent need to occur before prices can cool? I'm joined at the power table today by Isaac Matshego, the economist over at Nedbank Group, Azar Jammine, director and chief economist over at Econometrix, and Yvonne Mhango, the Africa economist over at Bloomberg Economics. Of course, you can let us know what you think about the discussion. Tweet us using the hashtag #PowerTable. To all of you, thanks so much for your time. And Yvonne, I want to start off with you, just reflecting on the broader pricing trends on the continent as we see the picture right now. Why is it, in your view, that we still have elevated inflation in some parts of the continent, inflation that is continuing to tick higher? Why have we not seen prices coming down despite the ramping up in interest rates that we have seen follow as a result?
Good afternoon, Fifi. Thanks for having me. So firstly, I think we've seen currencies come under significant pressure to depreciate. In the case of Nigeria, as well as Angola, we've seen a sharp depreciation of currency, particularly in the second quarter, in the order of around 40% against the dollar. We've also seen across in East Africa, the Kenyan shilling depreciate by around almost 20% in the year to date. And also in South Africa, the currency has moved by around 10%. So all that's adding to inflationary pressure that we're seeing on the continent. In addition, we've seen over the past quarter an increase in the oil price. We're sitting close to $100 per barrel, and that of course has implication for our oil importing countries. So inflation still remains our concern. We still have double-digit inflation in West Africa. It's only in East Africa and South Africa where we are seeing single-digit inflation.
Mm-hmm. And perhaps, Isaac, if you just add to that, in terms of your view on why inflation in many parts of the continent continues to remain sticky right now.
Sure, Fifi, definitely. I mean, in addition to Angola and Nigeria, as Yvonne has mentioned, Ghana is another problem. We see inflation. It was in the 50s until quite recently, but it remains in the high 40s. Remember what we're seeing in Ghana at the moment is basically the impact of the sharp currency depreciation in 2022. This year, we've seen the cedi basically being steady and pulling back slightly, but it is unlikely to have a beneficial impact on inflation because of the shocks that are being experienced by that economy.
Azar, perhaps speaking from the perspective of South Africa, I mean, we just had our numbers come out for the month of August. Yes, we saw a slight tick higher in the month of August by 4.8%, but nowhere near the peaks that we saw in July, where inflation reached levels of 7.8%. And I'd like to maybe add a different twist to the question as to why inflation remains sticky in some parts of the continent and not in others, and ask you whether the fact that inflation has been able to come down quite a bit in the southern part of the continent has been as a result of effective monetary policy transmission mechanism. Perhaps maybe just simply put, has monetary policy worked better in Southern Africa than it has in other parts of the continent?
I do believe it has worked better than in other parts of the continent. In South Africa in particular, we've got a very strong reserve bank that was preemptive in raising interest rates long before many other countries began raising their interest rates to quell inflationary pressures. But there is another factor, and to some extent, Yvonne gave you the numbers. The rand has depreciated by far less than many of the other African countries. For us in South Africa, we bemoan the incredible depreciation of the rand, but it has actually been less than in other African countries. Part of the reason for this is related to the demands that are being imposed on countries to adjust for climate change and to invest in renewable energy projects. And for many sub-Saharan African countries, the demands are really fairly pernicious in terms of the capability of the governments in those economies to generate the funds to actually fund these projects. Whereas in South Africa, there is scope for a lot of private sector investment potentially to come to the party. I think that has quite a lot of a role to play as well.
Okay. Yvonne, if we then stick to the point that you highlighted that has been echoed by the other panelists, the points around currency depreciation, some of the factors driving it. I mean, Azar talking about also the demands to adapt to climate factors right now amongst them. I also want to note a common thread between a lot of the countries that you made reference of whose currencies have depreciated quite significantly, the likes of Nigeria, Angola, I'd throw in Egypt as well as Ghana, who have also embarked on quite significant structural reforms in their economies that have brought forth the currency depreciation. I would argue that outside of Nigeria, a lot of the structural reforms that have been brought forth have been tied to some form of loans, either from the IMF or the World Bank, for these economies to sort of shore up from their fragile positions. And so I'd want to ask you whether you think that it is a driver right now of elevated inflation, the help that countries are seeking on the one hand from the likes of the IMF and the World Bank, and the unfortunate negative impact on the other hand that it is having on pricing pressures in their respective economies.
I think you have summarized it very well. That's exactly why you are seeing such pricing pressures. And in some of the meetings, like the G20 meeting last week, you saw the incorporation of the AU as a full member of the G20. But one of the important discussions was precisely how to restructure international financial institutions so that they can be more helpful than they have been of late to countries in Africa, to help them to to find ways of actually funding the enormous demands that are being made on them to move towards cleaner energy. So, both sides need to play a role here. Not only do we need the African countries, obviously, to try and adopt conservative and fiscally sound policies, but we also need the international multilateral institutions to somehow be a little more forthcoming in assisting these countries, because otherwise you're going to have such an imbalanced world economy that is to no one's benefit in the longer term, especially when you bear in mind that Africa's population is the most rapidly growing population of the world, and especially relative to Europe and the Far East, and the pressures on immigration and illegal immigration to the lower growth areas of the world lower growth population growth areas of the world is likely to simply accelerate. And we've seen what socio-political tensions are being generated as a consequence of this.
Sure. I mean, we've seen quite a number of protests happening across the continent, citizens just fighting against some of the pricing pressures and the cost of living crisis that they are experiencing. But Yvonne, to ask you the similar question around the structural reform programs that some of these countries are under, what role do you think they are playing in keeping inflationary pressures within the respective economies high at this stage? And do you see a light at the end of the tunnel?
Okay, so the policies we're seeing today are as a consequence of events that have taken place over the past 3 to 4 years. So firstly, we had the pandemic, and that was followed by Russia's invasion of Ukraine last year. And those events, of course, led to fiscal deterioration in Africa, and as unbalance of payments crisis in some cases. We've had also 2 countries default on their debt, that's Zambia and Ghana. And as a result, we've seen several African countries approach the IMF and are on IMF programs. And part of the reforms that are coming through as a result of these programs involve the currency being adjusted. So we've seen the Kenyan shilling, for instance, move over the past 2 years, more so than we saw over the several years preceding that. So we've seen devaluation of the Nigeria naira in the case of that West African country. That, of course, was not on the back of an IMF program. That's due to a new administration that came into office. But in the case of Ghana, we've seen similar movement in currencies as well as Angola. So a lot of the movement you're seeing, at least on the currency front, is rebalancing and reforms taking place in country. And that's, of course, contributing to the inflationary pressure we are seeing today.
Okay. Isaac, perhaps let's single out some of the individual country cases. Just starting off with Nigeria, we had the latest numbers from them, inflation continuing to tick higher, 24.1% in the month of July. They also host their Monetary Policy Committee meeting next week. And I'd just like your take on the outlook for that economy. That inflation, of course, being driven by reforms that the new president has driven in the form of trying to make the country a lot more attractive to do business. It has had a short-term pain that many are calling, but saying that there could be long-term gain. But your take on that outlook and how long it is long in Nigeria's case?
Sure, Fifi. I mean, we've seen the latest numbers, inflation numbers in Nigeria, just around 25%. But those numbers, I should stress, do not as yet reflect the impact of the sharp depreciation of the naira since June by around 40%, and also almost the tripling of fuel prices in some instances after, the fuel subsidy was cut. So more pain coming to Nigeria. And I will say that we've seen, for instance, from the last meeting of the Central Bank of Nigeria, MPC, a very close call with only six of the 11 members in favor of further hikes. So what I expect is that the CBN will be quite reluctant to hike further from now, despite the massive pressure on inflation. But these measures that we've seen from President Tinubu's administration are exactly what Nigeria has needed to do for quite a long time. And we would like to see a continuation of the reforms, for instance, addressing supply issues. I mean, for instance, now there's still that ban on imports. Almost 40 essential goods cannot be imported. The objective was to stimulate production in Nigeria, but unfortunately, due to the very long-standing structural, and I will say to a great extent, financial challenges in Nigeria, investment in production has not really taken off. So it would be quite important, I believe, to at least reverse some of those import restrictions to really address the inflation situation, because it's all about the supply issue.
Okay. Yvonne, a similar question to you, but just with the focus on the likes of Ghana and Egypt and maybe even Angola, who are under structural reform programs to, as you said, try and restore the health of their economies following the disruptions from the pandemic and more recently the Ukraine-Russia war. When do you see prices peaking in those jurisdictions?
Okay. So we've started to see some slowdown in inflation. So in the case of Ghana, inflation slowed more than expected to around 40%. So yes, 40% is particularly high, but that is a slowdown, believe it or not. The policy rate is at around 30%. So the rates in real terms still remain deeply negative, but I guess the trajectory is downward. So that's encouraging. The currency is also stabilized in Ghana, so that supports a further slowdown in inflation. In the case of Angola, they opted to hold the policy rate last week at around 17%. Inflation is sitting at 15%. It is ticking up. We do expect it to tick up a bit further given the sharp depreciation that took place in the second quarter of the year. year. While they've been cautious and have held for now, I think the risk is certainly to the upside in the case of Angola. If we look across to East Africa, we have seen some moderation in inflation in the case of Kenya, sitting around 6.7%, I think it is, for policy rate at 10. So that gives them some room to hold. I think they're meeting at the beginning of October. The issue in Kenya, though, is that the currency has come under pressure. As I mentioned, 20% depreciation year to date. It's likely to continue to do so, given that the demand on the FX side is a lot stronger than supply. They also have a Eurobond due in the middle of next year, June 2024. Energy prices have picked up, as I mentioned earlier, which puts pressure on their import bill. So certainly in Kenya's case, despite the moderation we've seen in inflation, we do think we'll have a hawkish MPC there, at least over the short term.
Azar, I just want to reflect on our numbers, South Africa's latest numbers once again, and just look at the food basket specifically, because, I mean, this has been a problem area for most parts of the continent. What economists had expected to be reflected this time around was the fallout of the Ukraine and Russia over the grain deal, and they had expected that to cause a tick higher in prices for food. That hasn't happened, and I'd like to get your take on why that hasn't happened and whether you think that we're out of the woods at this stage in terms of food prices and where they may go.
I think if you look at the breakdown of the change in the food price basket today, the surprisingly positive numbers were the sharp decline in the prices, not even year on year a decline, the absolute declines in the prices of meat products and milk, eggs and cheese. And to me, that speaks to an alleviation in some of the pressures for higher prices that we saw earlier in the year due to intensified load shedding. And now that load shedding in the last few months has been a little lighter than it was between March and May, I think that may have alleviated some of these upward pressures on food prices. The second factor is that the Reserve Bank's research has shown that there's a much stronger correlation between the movement of fuel prices and the movement of food prices than we used to believe was the case. It's a very strong correlation, and the fact that fuel prices declined quite nicely between May and July may well have also contributed towards less upward pressure on food prices.
Okay, so for you, there's not a lot around the Russia-Ukraine deal there in our food basket. There's other factors that are impacting prices a lot more.
Yeah, the international changes in food prices. You know, you had a spike in cereal prices a couple of days after Russia abrogated on its deal, and then prices settled back again to lower levels. Obviously, what does play a role is the depreciation of the rand, because even though the dollar prices of food may not have moved up, commodity prices, the rand price did have to move up because of the rand's depreciation against the dollar.
Okay, so right now the conversation it's a debate as to when a lot of these global central bankers are done with the current rate hiking cycle and when we can start seeing rate cuts. Just last week, the European Central Bank just signaled that they are essentially done. There's a debate as to whether what happens this evening is the last time the Fed moves or not, if there's another hike baked in the November meeting. The same goes for the Bank of England tomorrow. But ultimately, if these global central bankers are done, perhaps an argument can be made that it reduces the need for a lot of central banks on the continent to continue raising their rates, if we're saying that they're raising rates to protect the carry trade. And I'd like your thoughts on that, all your thoughts on that, on whether the slowdown in monetary policy and potential cuts in monetary policy globally will have a positive spin on what is happening on the continent as it does pertain to monetary policy here and also inflation. Isaac, beginning with you.
Sure, Fifi. It's all going to be about what happens to the US dollar and the impact on SSA exchange rates. I mean, we can start with Mozambique, which is in a pretty good position. The currency has been stable for almost 2 years now, and we've seen inflation basically remaining in the single digits. But there's a bit of a concern there. Supply issues are going to increase as the El Nino weather pattern sets in. Then, on the other hand, you take the likes of Zambia, or you can even throw in a Kenya there, where the currencies are likely to come under a lot of pressure. For instance, with Kenya concerns about the maturing $2 billion euro bond in the middle of next year. If we do not see a sort of smooth repayment, there could be more pressure on the currency that we've seen stabilizing in recent weeks. And the likes of Ghana are going to still be impacted by the very high levels of external debt. Hence, they need a very quick resolution of the debt situation by securing a debt restructuring deal, a favorable one for that matter. So it's all going to be about what the impact of U.S. monetary policy will be on the currencies of these countries via the U.S. dollar channel.
Okay, so essentially a whole lot of idiosyncratic factors there that are pushing and supporting prices in respective economies. It's not necessarily one event like the end of tightening in developed markets that will change the picture in its entirety. Yvonne, I'd like your take and the degree to which you think the end of tightening globally could soften the blow, albeit even if it's a teeny weeny bit.
Okay, so yes, we're waiting for the Fed's decision tonight. And of course, that has implications for the US dollar. So as Isaac rightly mentioned, if they were to tighten, then of course it will be negative for our currencies. But in terms of what would it mean for them to start, for rates there to peak, it does suggest that we could start to look at when, in terms of the short-term cycle, we could start to see rate cuts. For that, I'd look towards places like East Africa and Southern Africa, which have inflation in the single digits and also have positive real rates. Of course, there are other issues to consider, including energy prices, which may be a concern for all importers such as South Africa and Kenya, and those have to be watched closely despite a turn in the cycle in the US. So I think, in brief, there are quite a few domestic factors that need to be considered, even if the Fed decides that it has peaked. There is quite a few factors going on, including energy prices, Eurobond that's due, as Isaac mentioned earlier. But West Africa, I think, will be a lot later in the game in terms of their turn in the cycle, because inflation there remains in the double digits.
Okay. Azar, anything that you'd add that your respective panelists haven't already shared about what the turn of the cycle could potentially look like for some regions on the continent?
I think they've covered it quite well. The only thing that I keep posing in my own mind is if the end of the rate hiking cycle is due to concerns about a slowdown in economic activity around the world, and we start indeed seeing that slowdown, that would be accompanied in turn, in due course, by falling commodity prices, which could have a negative impact on currencies and on the current accounts of the relevant sub-Saharan African nations. I don't think that's a short-term issue, but from a slightly longer-term issue, if the world economy really starts suffering due to the lagged effects of higher interest rates that we've seen in the last 2 years, you then could see a negative impact on commodity prices. And with sub-Saharan African countries being primarily dependent on commodity prices, it could rebound negatively on them. So it's possible that you could see a better phase for currencies in sub-Saharan Africa, followed by a worse phase later on.
Okay. I think the jury is out on that one, whether the U.S. Federal Reserve will be successful in landing the plane softly without crashing the economy. And in that scenario, then perhaps the worst case scenario that you've described as of falling commodity prices and the subsequent impact on the currencies locally won't play out. We'll have to wait and see how that happens. But to all of you, thanks so much for your time, just sharing your thoughts on an important topic right now around monetary policy and the divergence of pricing pressures that we are seeing on the continent. I'd like to thank Isaac Matshego, the economist over at Nedbank Group, Azar Jammine, the director and chief economist over at Econometrix, and of course, Yvonne Mhango, the Africa economist over at Bloomberg Economics, helping us wrap up this week's Power Table.
Think beyond traditional business banking. Think a partner that gives you in-depth financial insights.